Hello, family. This is Dollar Will. I want to spend a little time talking about what's going on with that volatility indicator. But before I do, let me make it clear. Everything I say is my opinion. I'm not offering you investment advice. I have no responsibility for what happens to your money. I am just offering my opinion. I encourage everyone to seek the counsel of a professional investment advisor. Um, Look for a CMT, which is a chartered market technician. These folks are the professional chart readers. They have a license to give you information. Anyone else that I guess pretends to be authorized to give you information can be sued, and I don't want that to be me. So I am not your investment advisor. I'm just another person trading my own money. I don't manage anybody else's money, and I'm just offering my opinion. With all that out the way, the volatility indicator is something you need to pay attention to, especially for you crypto traders. It doesn't necessarily relate to cryptocurrencies, but it has explosive growth or profit potential and risk, just like cryptos. It's extremely risky. I'm pointing this out only to let people with a high risk appetite know that risky investment options exist in the traditional markets. Okay, high risk, high reward. Now, what I'm about to say regarding these options, it's not for newbies. I'm only offering this information to encourage people to become better chart readers, because as you improve as a chart reader, you'll be able to put the manage the risk and increase your chances of winning with options. Well, what we have here on screen is a picture of the S&P 500 since well, this is since 2009. It's freaking me out here because it says 2000 right here, and I'm like, wait a minute, no. And this is from 2009. That's just the scale I'm looking at. Okay, this is the S&P 500. There are these things called options. How can I explain options? Let's say you were renting an apartment with or a house, renting a house with the option to buy the house. That option to buy the house does not obligate you to buy the house. It gives you the right to buy the house, but not the option to buy the house. Well, with stocks, people buy these things called options, which gives them the right to buy more stocks in the future at a certain price. Let's say we're here in the market, or at the bottom here. Since I'm already here, and the price is $72, or the closing price is $68.92. This is where it was in 2009, the Spider, before it ran up to 200 and whatever. It ran up to $280, 286 at the high. All right. Let's say we're back here in 2009, and you say, okay, this is the bottom at 67.10. That's the low. And I think the price is going to go up in the next 2 weeks to $75. You can buy an option, and before the expiration of that option, you could buy more shares, even if the price went up. Let's say, again, you bought, when the price was 67, you bought an option that say the price was going to go to 75 or 80 bucks. And over time it went up. Let's say before that 2-week period when the options expires, the price went to $93. Well, if the option hasn't expired, you could still buy the shares for 75 or 80, even if the price went higher. So that's what people buy options for. Now, you can also bet that the price is going to go down. And if the price moves in your direction, you can make money. So you can exercise the option, and in this example, you would buy, although the price is at $93, you would exercise your option and buy a certain number of shares at 85. I'm sorry, 80 or 75, whatever the price was you had, and that price is called the strike price. So that's one way. Another thing you can do with an option is you could say, okay, now there's a whole nother market where people bid to buy the contract that you own. Say, you bought this contract to buy, bought this options contract to buy shares of SPY at $80 within the next 2 weeks, and the price is at 90. Well, some other people will be like, well, I'd like to buy those shares at $80. How much do you want for that contract? I'll buy your options contract from you so I can be the one to buy the 80 shares. So there's a market for your contract once you buy it. So there's a whole secret, not secret, side business going on, side activity, a side bet going on against the main stock. In this case, it's the S&P 500. But we could be talking about Apple or Google or just about every stock has an options associated with it, options market associated with it. It also applies to ETFs. Now, this SPY is an ETF, but it represents the S&P 500. But so all that to say, there's big money going on in a whole different market that's running parallel to the stock market called the options market. Okay, so what we're looking at here is the S&P, and okay, an options bet that the price will go up is called a call, CALL, like a telephone call, and a position or bet that the instrument, in this case the SPY or stock that you're talking about, a symbol that you're talking about, a bet that the price will go down is called a put. Now, options are incredibly complicated. I'm not trying to teach everybody how to trade options, because it's incredibly complicated, but it depends on being a good chart reader. So but there's lots of money in trading options, and lots of interest in people. People have a lot of interest in getting some of the money that's made in options. This being America, somebody came up with the great idea to create an ETF or ETFs, which represent the movement of calls options, which are bets that the price will go higher, and put options, which are bets that the price will go lower. These, let's see, they created ETFs representing the puts and other ETFs representing the calls. So what we have here is this symbol is called VIX, VIX. And you hear people talk about the VIX or volatility indicator. This is what they're talking about. There are many symbols that represent the volatility indicator, but the volatility indicator is basically measuring the ratio of puts to calls with regard to a particular stock or trading instrument. In this case, we're talking about the spider, which is the S&P 500. And this VIX symbol is showing you that the puts are outweighing the calls. There's not a lot of market demand, not a lot of people betting that the S&P 500 was going to fall over this long period. So some people, instead of going into the options market to buy a call because it's complicated, they will buy a ETF, which represents which represents a put or a call. In this case, this VIX it represents, I guess in brief, I can say it represents the puts. So if you think the market is going down and you want to get like an explosive kind of return on it, a lot of people will go and buy a put in the form of the ETF. Now it's dangerous because these things don't always do what they should do. So that's why you hear people on TV, they're really trying to ban these things. All right. Now this one is called the XIV that everyone's talking about. And the XIV is this symbol represents the call options against the S&P. It represents bets that the S&P will rise. So you're saying, why not just buy the S&P itself or the SPY itself if I think the market is going to rise? Well, because sometimes this moves faster, moves at a greater rate. The increase in many times is greater. So that's why that's why some people choose to buy the ETF representing the call options as opposed to buying the S&P 500 directly or an SPY ETF. Okay, what happened with the XIV is some people tried to get smart and they were hanging around within this XIV. Like I said, it's risky. Instead of buying the SPY, they bought the XIV, which is the call options. And then it tanked. It tanked. It went from a high in January, I think it's around January 11th. Let me go down. The high in January 11th was $146. January 5th, the high was 118, and then January 6th, yesterday, it tanked. So in one day, it went from a high of 118 on the 5th to a low of $5.50 the very next day. That decline caused people to lose up to 93% of their position, of their money, in one day. So while they thought they were being smart for this whole period, since 2009, I don't have data going back to 2009 for this symbol, but they were in one like this, if not this one. They were in this VIX as the market was going up. And since January 11th, but mostly in one day, which was 2 days ago, 48 hours ago, they lost 93% of their money. They wiped out everything going back to maybe 2009 or 10. They lost it, essentially lost it all in one day. 2 lessons. Be a technical trader. Who lost their money? Mostly fundamental traders who don't watch charts, who don't know how to read charts, who don't think it's important to read charts. These are the type of people that essentially sat in this the whole time, and they thought that it was safe to buy on the dips as it was coming down. They had that buy on the dip mentality, and then they got destroyed. I want to show you something else very unique. On January 13th, I did a video about the S&P. I'm sorry, about the Dow Jones, and how it looked like we were very near the top. And I made a long range. Gave long range information about a super cycle decline. And I believe I made reference in that video about something odd happening in the market, where the options started. The put options started to rise as the market was also rising. That's not supposed to happen. That was strange. As we see here, on January 26th, that was the high in the S&P 500. So the decline started January 26th. Let me see. Let me show you. Now, this is the volatility indicator representing the puts. The one that shows that basically while the S&P 500 was going higher, nobody wanted to bet against it, or there was declining interest or declining desire to bet against it, except for starting January 11th, the volatility indicator, the VIX, the bets against the market, the pessimism indicator. We also call it the fear index. This fear index hit a bottom on January 11th. Remember, the S&P 500 hit its high on January 26th. So although the price kept moving up, people started feeling bold enough to buy options against it. So the price went from a low of $10.84 to a high of $23.28 in what's that, 3 weeks? Doubled your money? So this is like crypto. Crypto level of gain, doubling your money that fast. And that's what's going to happen with these volatility indicators. But they are options are risky, and these volatility indicators are risky also, because just like this index didn't do, this volatility index didn't do what it was supposed to do, which was continue falling until the 26th. It changed directions. Well, it'll do that to you later on the other end of the scale too. When the market drops too low, the people will stop buying these puts, and this symbol will get funny and do something odd. The only defense around it is to be a chart reader and have the good sense not to put but so much with so much money in it. And you have to read this chart as an independent symbol and not expect that it's going up just because the market is going down, because as I just explained, sometimes these symbols don't do what they quote should. Okay, but when they don't do what they should, that's a sign that a change is coming. And that's what made me do that video on January 13th, telling everybody I think we're at the top. Okay, that was one of the things that tipped me off. Okay, I want to go back to my example. I like to say to people, about trading stocks is sort of like what you see on TV, or what you've experienced maybe at an auction. At the beginning you have a number of people. You might have a dozen people bidding on a product, and at the end you just have two guys in an ego battle or two people in an ego contest about trying to see who's going to win that product. Well, in stocks, we call that the greater fool theory. You're always looking for a greater fool than you to buy the thing. And over time in that auction, everybody else realized that the price of the thing wasn't worth it. The price was too high that those idiots were bidding on. And at some point in time, the masses of the people, and that's what I'm saying this volatility indicator represents, the masses of the people said, you fools are crazy. The S&P 500 is not worth that. And so they started betting against the two fools. And the two fools lost. And these folks lost essentially everything in one day. But when somebody loses, somebody wins. I'm trying to show you something here. Okay. This symbol SVXY, it is similar to, let me see. Hold on, give me a second. Okay, so this stuff is it's confusing to me, even about the direction the puts and the calls, and one's going in the direction of the symbol, another one is going the opposite direction of the symbol. I'm gonna go back. I'm gonna go back to this right here. Again, this is the ETF representing the call options, bets that the S&P 500 would go higher. These are people that chose not to invest in the S&P directly. They wanted to invest in a symbol that mimicked the rise of call options, because call options rise faster than the symbol itself, or the index, in this case S&P 500 itself. Now, technical traders that want to profit off of the fact that fundamental traders think that every dip should be bought, they take the money of fundamental traders by shorting this symbol, because we technical traders know that fundamental traders hang out in risky symbols like this. And at a certain point in time, this point right here in time, their buy on the dip strategy is going to fail. So what happens is you buy a put against this ETF, which represents a call. Yes, it's confusing. So this ETF is representing calls or bets that the market will go up. You can buy a put, or you can bet against this symbol in the form of buying a put option against this symbol. This is what they mean when they say the word derivatives. It's a trading instrument that derives its value from something else. So we have derivatives of derivatives. Okay, and too much in bank investing in derivatives is what caused banks to suffer as much as they did in the housing crisis, and it's happening again because we are greedy and we cannot walk away from the explosive gains that can be made by investing in derivatives and derivatives of derivatives. Okay, so expert chart readers that know a little bit about options decided to let's take advantage of fundamental investors who don't read charts and think every dip should be bought because the price is just going to go up to the moon. They never believe that it's over until it is actually over. So some folks stepped up and bought put options against this symbol. And let me show you how they made out. In this case, This SVXY is one of these symbols like this one that goes up. It's a call. It represents call options. Okay, it's just another one. It says 82% down at the close, but during the middle of the day, it was down as much as 93%. It opened on Monday at it closed at the end of the day on Monday at $71.82. And like I said, it was even higher during the day Monday. But let's just say you bought the option at the close on Monday, and this particular symbol has a strike price, meaning somebody was betting that this symbol SVXY would go down. On Monday, they thought the price was going down further, and they bought a put contract at a strike price of $55. They said, I think that this SVXY is going down, and I see that there's a contract for a put option at $55 that only costs a nickel. The contract costs a nickel. And so each contract represents like 100 shares. And so it gets into a complicated formula. Let's just say you can buy, each contract is worth 100 shares. You buy the contracts in, let's say you bought 20 of those contracts, 20 lots. They're sold in lots. Let's say you bought 20 of those. That would be, let's say, $100 worth. Just to give us something to work with. So for putting up $100 to buy bundles of these contracts that's worth a nickel would give you, let's see, all right. So here we are. This SVXY. Let's see. I'm trying to find the one I'm looking for. These are the strike prices. I'm trying to find the one. I took a screenshot of the $55 strike. This is it. This is a $55 strike price put. The price rose from a nickel. The value of the contract itself rose to $43. Hold on now. No. I'm sorry. No, that's wrong. The strike price, remember, the strike price was $71. The strike price fell to $43. Let me see. The reason why I'm struggling is because this top, that's why this top part tells me what the columns are. Okay, right. Okay, so this is strike price. The third one is the last price. Gotcha. Okay. The last price of the day was $43.65, but the opening price, the previous close, it was $71. That options contract that was worth a nickel rose in value 87,200%. So $100 would have returned 87,200 minus fees and stuff. If you're an options trader and you think I'm doing this math wrong, put it in the comment section. But I'm pretty sure I'm getting this right. It's just that this number is so staggering that my mind can't calculate math this high. I mean, just the idea of putting $100, investing $100 in options, and it increasing 87,200% in one day, less than a day actually. That's mind-boggling. Now, the person that bought this option when it was $71 and the option only cost a nickel, they were not thinking, I don't believe they were thinking, oh, this price is going to actually go to $55. As the price, let's say, as the price fell from 71 on its way to 55, the value of that option contract rose above a nickel. I think the person was thinking, okay, it's going to drop a little bit, and the contract will move from a nickel to 20 cents or 15 cents. So I get to make 3 or 4 times my money, okay? Or let's say it goes to 20 cents. I put up $100, and in a day or two, I make $400 or $500. I think that's what they were thinking. But the fact, and so that's called out of the money, where if you have a strike price of 55 and you buy in when the market price is above, say, $55, that's called you have an out of the money option. As the price but when the price drops below your strike price, you have a in the money option. As the price moves from, say, out of the money, meaning above your strike price, to in the money, which is at or below your strike price, you start to get phenomenal results at that point. No, it's not like this. It's not 87,000%. Okay. People usually, you can make 500%, 1,000% over a few days or a week in the options market if you time it just right, or over, let's say, a week or two, you can make that. Let me say that, a week or two, sometimes even more than 1,000%. Okay, but it's all based on chart reading. And I just wanted to show y'all this. I'm not trying to turn you into options traders, but I do want you to see, if you're trading cryptos because the risk reward, the risk is worth the reward, I'm saying continue to improve as a chart reader, and you can pursue high risk and high reward in the options market as well. I'm not trying to talk anybody out of cryptos, because I want to trade currencies myself. Okay, but I'm just trying to communicate to you that cryptocurrency, in the world of high risk, high reward, fast money, cryptocurrency is not the only game in town. The options market has been around a while, and that's where the fast money is made, the traditional way that the fast money is made. And just as there are Bitcoin symbols now in the stock market, start taking a look, or maybe I'll just periodically post options activity for those explosive Bitcoin movements, to show you who made who made how much on the option side of the equation. So there are a lot of ways to make money trading. You can trade stocks, you can trade ETFs, you can trade in the Forex market, you can trade, of course, that includes, I guess somewhat includes cryptocurrencies, and you can trade in the options market. But all of it requires that you become good at reading charts, good at technical analysis, in order to move the odds in your favor. That's all I got for now. I'm sorry for this long video, this extra long video, but this is a very complex subject matter. The subject of the volatility index and options in general is complicated. I know most Americans don't understand what they're hearing when they hear about the XIV why the issuer of the Credit Suisse basically discontinued it. I believe they pulled it. I don't know. I know they halted trading on it. I think there's talk of ending these volatility indexes because of this explosive move to lose 92% in one day. But I think that's crap because I've invested in these things and I've lost a lot of money. I didn't put a lot in there, but I'm just saying, of whatever I put in there, I suffered big losses because I've been on the wrong side of this equation. So now that people who were pessimistic against the market, now that they're starting to win, now everybody wants to change the rules. Wait a minute. Wait a minute. No, it doesn't work that way. The market is not, it's first of all, it is a market. That means you have buyers on one side and sellers on another. You don't change the rules just because you started losing. You know, when you were taking the other person's money, you were happy. Well, a market means that the other guy gets to win sometime. Okay? So I don't want to turn this into a rant much further, but on this feed. But I assure you, I will be ranting more about it. That's a pet peeve of mine. But I'm Dollar Will. Like, share, and comment. Definitely share. Peace.